Joining us to react, Goldman Sachs Chief Global Equity Strategist Peter Oppenheimer. I know you've been listening as well, Peter. Just give me your take. Anything you heard there that was of particular interest?
Well, I think that, they were keen to demonstrate the separation between fiscal and monetary policy and how important that was for them. And I think were very clear in their guidance that they must continue to do what is necessary to control inflation, which is, of course, consistent with what they've been saying recently. And I think being slightly more on the hawkish side than markets have been pricing. So while on the good side of the ledger, we have economies which we believe will avoid recessions, inflation and interest rates are likely to be stickier than markets have been pricing. And I think they're really recommitting their resolve in that direction.
Yeah, they seem committed to slaying the dragon, so to speak, of inflation. What do you believe that will mean in terms of future policy and or the impact, of course, on what you follow closely, namely the economies and markets of these countries in question?
Well, the good news is that inflation is coming down, but it's coming down slower than I think they would like to see, particularly core inflation. And for us, that means that interest rates have got further to go, but probably stay higher for longer than the markets are still pricing. So while we are confident that we will get soft landings across all the main economies, I think that, rates are going to be at a higher level through most of the next few months into the middle of next year at least. And that really, I think, when you translate it into financial markets, means that there is really a cap on risk assets from here. We've seen a big rally in equities, of course, over recent months. And much of that, I think, is reflecting an increasing degree of confidence that we can avoid recessions and that inflation has peaked. And of course, we've seen some easing of some of the tail risks that people worried about earlier in the year, whether it be the US budget or indeed the regional banking issue. But nonetheless, that rally has been very narrowly driven by a few companies, and the average company has been relatively flat, and we think that will probably continue for some time in equity markets.
Yeah, I like that point in your latest note, Peter, where you talk about just the narrowness. And I think it's important to put that in context of other nations as well, especially as we watch this ECB forum. You say that, the 15 biggest companies have driven 86% return in the U.S. year to date, 100% in Asia, and Europe's market breadth has been somewhat healthier. But given kind of the optimism that you laid out, do you think that this is going to continue, this kind of narrow market optimism throughout the remainder of the year, or do you think that it does kind of widen out from here?
I think it probably will broaden out a little bit, but that's more in the context really of still a relatively what we call fat and flat market range. What we mean by that is really that point to point, we're not really getting a lot of appreciation in index levels or the average company, but we are seeing quite a large range, trading range, which is reflecting, this sort of trade-off in fears or hopes around peaks in inflation and interest rates and troughs in growth. I do think it will broaden out, though, mostly if we look at historical periods of very narrow leadership. Generally, equities have held up in the 12 months or so that followed those very narrow periods of leadership. And generally, more often than not, it is because you've seen some broadening out of returns. And that's what I think we'll probably see moving forwards. But again, I would emphasize that if you look at the median company, in most markets, there's been very little change in value this year. And we would expect to see relatively modest returns over the next few months, bearing in mind that profit growth is pretty pedestrian in most markets, a little bit better in Japan, I would say, than the US or Europe. We still have high interest rates, and that's a higher bar for equities and other risk assets to beat. And valuations are not that cheap, particularly in those leading companies which have generated the most of the rally.